Hi everyone, in this video I will show you how to use candlestick pattern for profitable trading. There are different types of candlestick pattern. We have the bullish candlestick pattern and we have the bearish candlestick pattern. A candlestick pattern is a way of displaying information. A candlestick is a way of displaying information about a price movement. Candlestick charts are one of the most popular components of technical analysis. It enables traders to interpret price information quickly. With the help of candlestick, traders will be able to interpret price information quickly. Like I've said earlier, there are different types of candlestick pattern. We have the bullish candlestick pattern and we have the bearish candlestick pattern. The bullish candlestick pattern may form after a market downtrend and signal a reversal of price movement. They are an indicator for traders to consider opening a long position for profits from any upward trajectory. The type of bullish candlestick pattern, we have the hammer. Hammer is one of the bullish candlestick pattern. The hammer candlestick pattern is formed of a short body with a long wick, as you can see. This is the hammer. This is a hammer, as you can see. It has a short body, as you can see, with long wick. You see this at the end of downtrend. It signals that buyers will soon take over the market. It signals that buyers will soon take over the market. A hammer shows that there were selling pressures during the day. Ultimately, a strong buying pressure drove the price backward. So the color of the body can vary. The color of this hammer body can vary. The green hammers indicate a strong bull than the red hammers. If you see the green hammer, it indicates what? A strong buying pressure than the what? Than the red hammer, as you can see. So the next bullish pattern, we have the inverse hammer. The next bullish pattern now we have the inverse hammer. A similar bullish pattern is the inverse hammer, as you can see. This is the inverse hammer. This is it, the inverse hammer. As you can see, the only difference being that the upper wick is long while the lower wick is short. The inverse hammer is similar to the hammer, but the only difference is that the upper wick is long while the lower wick is short. As you can see, long upper wick and we have what? Short lower wick. That's it. It indicates a buying pressure also, followed by selling pressure that was not strong enough to drive the market price downward. The inverse hammer suggests that buyers will soon have control over the market, as you can see. It indicates what? A buying pressure, followed by what? Followed by a selling pressure. A buying pressure followed by a selling pressure. So we now have the inverse hammer. If you see this signals that buyers will soon take over the market. So the next bullish signal, we have the bullish engulfing candle. We have the bullish engulfing candle. The bullish engulfing pattern is formed of two candles, as you can see. 1, 2. The red candle and the green candle. The green candle will close above the red candle. So we call it bullish engulfing candle. The first candle is a short red, as you can see, red body, short red body, that is completely engulfed. It is completely engulfed by a larger green candle. As you can see, the large green candle will close above the short red candle. We call it bullish engulfing candle, as you can see. So this also signals bullish trends, upward trends. So the next candle stick pattern is the piercing line. We have the piercing line. The piercing line is also two stick pattern made up of long red candle followed by long green candle. A two stick candlestick pattern made up of long red candle followed by what? Long green candle. As you can see, there is usually a significant gap down between the first candlestick's closing price and the green candlestick opening price, as you can see. It indicates a strong buying pressure as the price is pushed up to or above the mid price of the previous day, as you can see now. This is the red candle, and we have the green candle closing above the middle of the red candle. It signals upward trends. So the next candle, we have the next candlestick pattern, we have the morning star. The morning star is also a bullish pattern, candlestick pattern. The morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It is three-stick pattern, one short body candle between a long red and a long green, as you can see. It's a three-stick candlestick pattern, one long red between one short red between a long red candle and a long green candle, as you can see. You see this pattern, it signals there may be upward movement. It signals that selling pressure of the first day is subsiding and a bull market is on the horizon. So the morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It is a three-stick pattern, as you can see. One short body candle between a long red, one short red candle between a long red and a long green, as you can see. So this signals that the selling pressure of the day is subsiding and the bull market is on the horizon. So the next bullish pattern, we have the three white soldiers. The three white soldiers. The three white soldiers pattern occur over 3 days. It consists of consecutive long green candles with small wick, which open and close progressively higher than the previous day, as you can see. It is a very strong bullish signal that occurs after a downtrend and shows a steady advance of buying pressure, as you can see. A three long, as you can see now, it consists of a three long green, first green, second green, third green, as you can see. First green, second green, third green, with small wick or no wick. With small wick or no wick. You see this signal, 1, 2, 3. It signals that it signals a bullish market because it's a very strong bullish signal that occurs after a downtrend. As you can see, you see this, it signals a bullish market. So the next, we go to the sixth bearish candlestick pattern. The bearish candlestick pattern. We go to the bearish candlestick pattern now. In the bearish candlestick pattern, we have the hanging man. This is it, as you can see. So we have the hanging man. This is it. The hanging man is the bearish equivalent of hammer. It resembles hammer. The hanging man is the opposite of hammer, as you can see. It's the equivalent of hammer, I mean. It has the same shape, but forms at the end of uptrend. That's the only difference. Hammer will form at the end of downtrend, but hanging man will form at the end of uptrend, as you can see. It indicates that there was a signal sell-off during the day, but that buyers were able to push the price up again. You see this? It indicates that there will be what? There will be downtrend. There may be downtrend. It indicates that there may be downtrend. The hanging man indicates that there may be downtrend. So the next bearish signal, bearish candlestick pattern, we have the shooting star. The shooting star is the same shape as the inverted hammer, but it is formed in the uptrend. The shooting star is same as inverted hammer, but it is formed in the uptrend, and it has a small lower wick and a long upper wick, as you can see. This is an inverted hammer. This is a shooting star. This is a shooting star. It has what? A long wick at the uptrend and a short wick at the downtrend. We call it shooting star, as you can see. So as you can see now, uptrend, uptrend, uptrend. Then we have shooting star signal candle. So after this shooting star candle now, the shooting star candle signals there may be downtrend, as you can see. So the next candle now, we have the bearish engulfing candle. The other time we discussed about the bullish engulfing candle. So now we have the bearish engulfing candle. The bearish engulfing pattern occurs at the end of the uptrend, as you can see. This is an uptrend. This is an uptrend now. It occurs at the end of the uptrend. The first candle has a smaller green body that is engulfed by the subsequent long red candle. It is engulfed by the long red candle. This long red candle will close below the green candle. We call it bearish engulfing candle. As you can see now, it signals that there may be what? Further downtrend. It signals that there may be further downtrend. As you can see this direction, potential direction. It signals that there may be further downtrend. So the next bearish pattern now, we have the evening star. The next candle pattern now, we have the evening star. The evening star is a 3 candlestick pattern, as you can see. The other time we discussed about the morning star, but now we have the evening star. This evening star, as you can see, is a bearish signal, a downtrend signal. It's a bearish signal. The evening star is a 3 candlestick pattern that is equivalent of the bullish morning star. It is formed of a short candle sandwiched between long green and long red. A short candle between long green and long red. We call it evening star. You see this signals downtrend. As you can see, long red, short candle in between long red, long green and long red. We call it evening star. This signals downtrend, as you can see. So the next candlestick pattern now, we have the 3 black crowns. We have the 3 black crowns. The next candlestick pattern is the 3 black crowns. The 3 black crowns pattern comprised of 3 consecutive long red patterns, long red candles with short or non-existing wicks, as you can see. This one is similar to 3 white soldiers now, as you can see. As you can see now, long red, 1, 2, 3. First red, second red, third red. The downtrend candles, second downtrend candles, third downtrend candles. This signals further downtrends. You see this signal is indicate that there may be what? Further downtrends. As you can see, the second red candle will close. As you can see, it closes. As you can see now. So we call these 3 black crowds. The 3 black crowds. So the next candlestick pattern now is the dark cloud cover. We call it dark cloud cover. A dark cloud cover candle pattern indicates a bearish reversal. A black cloud over a previous day optimism. It comprises of 2 candlesticks, a red candlestick which opened above previous green body, as you can see. A red candlestick, it opens above previous green body. It opens above this, as you can see. Call it dark cloud cover. It signals that the bear have taken over the session. It signals that the bears have taken over the session. You can see this green candle now. This red candle now open above the green candle. It signals that the bears have taken over the session, the market. So the next candlestick pattern now we discuss about the 4 continuation candlestick pattern. The 4 continuation candlestick pattern. If a candlestick pattern does not indicate a change in market direction, it is what is known as continuation pattern. So we discuss about Doji. Doji. The first pattern now is Doji. The first pattern now is Doji. So when the market open and close are almost at the same price point, the candle resemble a cross or plus, as you can see. Cross or plus. You see this sign, this is a Doji, as you can see. This is Doji. The green here is Doji. The red here, candle here is Doji. This is Doji. So when you take a look at the upper wick is the same as the the same to the lower wick. Is equal to the lower wick, I mean. The upper wick is equal to the lower wick, as you can see. This is the Doji. Take a look at the red candles also, red Doji also. The upper wick is equal to the lower wick. That is Doji, or what we call Doji. So this signals that buyers should close the market. This can help traders to identify a period of rest in the market. We call it a neutral price movement. We don't know whether the price is going upward or the price is going downward. So it helps the traders to identify a period of rest in the market. All you need to do is to stay neutral. Don't trade. Wait for the market to go upward or to move downward. So the next pattern now we have the spinning top. We have the spinning top. The spinning top candle pattern has a short body centered between wicks of equal length, as you can see. It has a short body centered between the wick of equal length. Between the wick of equal length. As you can see, we call it spinning top. As you can see, we call it spinning top. As you can see now, the spinning top. The wick is of equal length. The wick is of equal length, as you can see. The pattern indicates indecision in the market, resulting in no meaningful change in price. The bulls sent the price higher, where the bears pushed it low again. Spinning top are often interpreted as a period of consolidation or rest, following signals of uptrend or downtrend. So these signals, we don't know where the price will move. As you can see, position of the price may be upward or downward. So the next now, we have the following three methods. We also have the following three methods. The three method formation pattern are used to predict the continuation of a current trend, be it bearish or bullish. The bearish pattern is called the following three method, as you can see, 1, 2, 3. It is formed of a long red body followed by three small green bodies and another red body, as you can see. The green candle are all contained in the range of the bearish body, as you can see. This 1, 2, 3 is contained in the range of the bear, but in the range of this red candle, as you can see. 1, 2, 3 is contained in the range of the red bodies. It shows traders that the bull do not have enough strength to reverse the trends. So this signals further downtrends. The next candle we have rising tree method. The next candle we have rising tree method. The opposite is true for the bullish pattern called the rising tree method. It comprises of three short reds. You can see 1, 2, 3, three short reds sandwiched within the range of two long greens. One first green and the second green. As you can see, the pattern shows traders that despite some selling pressures, buyers are retaining control over the market, as you can see. And this signals uptrend. It signals uptrend. So that is rising tree method. That's rising tree method. So you can subscribe to my channel to watch the next video. Thanks.